So what is a bank looking for in terms of an application, and how do they actually arrive at the loan amount that they're prepared to give you? So what I'm going to do is explain to you in the way of a case study with South African clients that I deal with, just typical clients that I deal with on a daily basis. So if you go into the right-hand side of the slide, you will see that the husband is working. He's got an income of $85,000 gross. The wife is working. She's got the same income, $85,000 gross. They're both in KiwiSaver. They are contributing 3% to KiwiSaver at the moment. They live in Tauranga, just as a guide. They have got a credit card limit of $10,000, of which the balance is only $3,000. And that becomes crucial a little bit later on in my explanation. So just remember that. And then they've got consumer finance of $1,000. They got to New Zealand, so they had to buy a car. They didn't have a car, obviously, in New Zealand, so that's finance for that was $30,000. The husband is 35 years old, the wife is 34, and they want to buy a house in Tauranga, as I said, just as a way of explanation, for $750,000, and they've got a 5% deposit. So they have just gotten their resident visa. It might have been a month or so ago. They've been resident in New Zealand for the past 2 years, and they've lived in New Zealand for more than 184 days in the past year. So they well and truly qualify to buy a property in New Zealand. The deposit has come from, they've just recently completed the process of financial immigration, so they've cashed up their RAs in South Africa, and so now they can use the money in New Zealand. So that's, as I said, roughly the kind of clients that I deal with. So on the left-hand side is my little model that I've built. So it's not based on a bank's model as such, but it's just something that I find useful if I do speak to clients to find out if I can help them. So what the bank wants to know is that you will be able to afford the loan repayments, and not just afford it. They want to know that there's a healthy surplus every month. So if I take you through it, on the left hand side, you'll see that the husband's after-tax income is $5,000 roughly per month. The wife is the same, obviously, because they've got the same salary. So in total, they'll take home about $10,000. I referred earlier to the credit card balance and the limit. So with the credit card, the bank takes 3% on average of the credit limit, because their view is that you can use that credit tomorrow, and because of that, they want to make sure that that banks are always conservative, and they want to make sure that it's reflected in the calculator. In this case, the client's got a car loan payment of $744. They've also got a consumer finance payment of $300. They might have bought some furniture, and they've only got a little bit left to pay on that. So they've only got $1,000 in terms of a balance. So banks, when you've got a small deposit especially, the banks don't like it if you do have a lot of debt, especially consumer debt, things that they view as avoidable, like buying furniture on credit and stuff like that. Average household expenses for a family of four is about $2,800, and you will see in this example there's a healthy surplus of $1,500 per month. And that is good because they've only got a 5% deposit. So the bank, again, banks are quite conservative. They want to make sure that they're well covered. So as I said, in this case, I will put it forward. If the surplus was much less, maybe only 500 or so, I would have thought, well, it's getting the possibility of an approval is less likely, because it's only a small deposit, so that's risky in itself. And then also, it's only a small monthly surplus. And so what happens if something goes wrong in terms of the family finances? As a rule of thumb, the bigger the deposit, the less surplus the bank is prepared to accept. Again, just because of the risk, obviously. So on the right-hand side, at the bottom there, you'll see there's an area highlighted in red. You've been seeing on my posts just lately that I'm talking about debt, and if people take on a lot of debt, that banks don't like it, because it increases the risk, because that's obviously another payment to make, but it also could tell the bank a little bit about character in terms of how people spend their money. In this case, if the client didn't have any debt, believe it or not, you'll see on the bottom there, they could potentially have been approved for a loan of $915,000. So that is nearly $200,000, well, it's more than $200,000 than they would have been approved otherwise, like they are now. So as much as possible, I would recommend that you don't take on debt. I know it's not always easy when you get to a new country. You have to set yourself up, get all your furniture and stuff here from South Africa. Maybe husband or wife is not working straight away, and so you have to actually, whoever's got the income can then borrow money and then get a credit card facility and get yourself underway that way. I do understand it, but as much as possible, if you can keep the debt levels down, your chances of an approval is for a high amount is much greater. So I hope you found it helpful. Let me know if there's any questions. Have an awesome day. Thanks a lot. Bye-bye.